All right, good morning, everyone. Welcome to the 2019 Economic Outlook Breakfast. My name is Christy Gillenwater, and on behalf of the Chamber's Board of Directors and staff, it's my pleasure to welcome you to today's event. Given everything going on in the country and internationally, I think it will be an exciting topic today. I think I speak for all of us when I say, Dr. Bostic, we are looking forward to your remarks today. We are going to start off today's program, of course, as always, with an invocation, as well as our national anthem. So I'd like to welcome at this point Ann Weeks, okay, and Mary, if you could come on up to the stage and kick us off. Thanks.
Thank you. Please join me in prayer. Gracious God, we give you thanks today for the many blessings you have bestowed upon us, for the beauty and wonder of your whole creation, for our homes, families, and friends, for the brave and courageous who keep us safe, for minds to think, hearts to love, and hands to serve. We give you thanks. And as we begin this new year, please look with compassion on your whole human family. Take away the arrogance and hatred that can infect our hearts. Break down the walls that can separate us. And unite us in bonds of love so that we may accomplish your purposes on earth and serve you in harmony. We ask your blessings upon the food you've given us today. Bless the hands that have prepared and served it, that we may use it for the nourishment of our bodies and us to your service. In the meantime, continue your blessings upon us, that we may pay it forward and be a blessing to others. It is in your holy name we ask these things. Amen.
Please rise for the singing of our national anthem. Oh, say, can you see by the dawn's early light what so proudly we hailed at the twilight's last gleaming, whose broad stripes and bright stars through the perilous fight o'er the ramparts we watched were so gallantly streaming, and the rocket's red glare, the bombs bursting in air, gave proof through the night that our flag was still there. Oh, say does that star-spangled banner yet wave o'er the land of the free and the home of the brave?
Thank you, Ann. Thank you, Mary. Gosh, Mary, such a beautiful voice. All right. Well, as always, chamber events are never as dynamic without our amazing sponsors. So I'd like to thank all of our sponsors for making this event possible. First of all, our presenting sponsor today is Bank of America Merrill Lynch, so thank you very much. Along with our platinum sponsors, EPB, Sandler Training, Volkswagen of Chattanooga, as well as our gold sponsors, Blue Cross and Blue Shield of Tennessee, Chambliss, Bonner, and Stoffel, Chattanooga Airport, Earl Langer, Food City, The Grandview, J.D. Frost and Company, Novatech, Pinnacle Financial Partners, Unum, Synovus, and VaynerMedia. Thank you to all of our sponsors for your support today. So by any measure, it's been another stellar year for not only Hamilton County and Chattanooga, but our region as well. We'll look at a few local numbers here today, have a little bit of a local discussion. We'll also hear from County Mayor Jim Coppinger, as well as City Mayor Andy Burke, and then we'll hear from Dr. Bostic, who is, as you all know, the CEO of the Federal Reserve Bank in Atlanta. So we've had some big wins here in Chattanooga and Hamilton County. First of all, many of you may have seen the article this week around the airport and the number of employments. It's amazing to see, again, third year in a row of record passenger travel here out of the Chattanooga airport. And we all know the unemployment rate is extremely low. You've all felt that in your organizations. And in April of 2018, we hit a 10-year low at 2.8%. We've had a number of business expansions here in Hamilton County and Chattanooga as well. Again, just to name a few, Mueller Water Products, Nichols Fleet Equipment, Freightways, and Miller Industries. We've also had amazing explosion in our startup scene, and that's due to so many partners in this room and throughout the community who are very focused on our startup ecosystem. And Steve Case's Rise of the Rest competition visited here last May, as you all know, in Chattanooga to really check out our entrepreneurial scene, and we were one of just a small host of communities for that tour this year. And the startup tour, through Steve Case's work here, spotlighted several local organizations who are becoming household names, such as Freightways, Branch Technologies, CPR Wrap, and Egla Gear, along with many others. And we all know that developing our talent pipeline is really critical to the future success, not only of our existing businesses, but also of our prospective businesses. And we're excited about the work that Chattanooga State Community College is leading. And this includes this program, which is the first college-sponsored apprenticeship program. Again, and we're proud to be partners with Chat State on this. These flexible earn-while-you-learn programs allow participants to earn a salary while in career training, removing the barriers that community members sometimes face when it comes to securing high-potential, high-quality jobs. So we appreciate them for their vision on that. Speaking of jobs, one of the many ways we provide value as a chamber in our community is promoting Chattanooga and Hamilton County on a national and international level. And last week, hopefully you all saw, Business Insider named us number 4 on a list of up-and-coming cities, ranking Chattanooga by criteria like affordable housing and places where workers in their 20s and 30s want to move. As you know, rankings such as these help you to attract talent to your team. They help us in terms of our economic development efforts here in the community. And as it relates to not only attracting businesses here, but also talent development and talent recruitment initiatives. So we continue our work, as you all know, through the Greater Chattanooga Economic Partnership, working throughout the region, 3 states, 16 counties, to advance our regional economy. And we are so grateful to our elected partners, our economic development partners throughout the region. And while the 2018 data is not final, you can see from these slides here that we've enjoyed the creation of 19,000 plus jobs with more than $5 billion worth of investment. And our recruitment efforts continue. I'll tell you, December, and talking to Charles and his team, was one of our busiest yet. And so we're extremely excited about our pipeline. What's interesting, you see here, we often don't even know who we're talking to, right? Who that end product, end company is. But you'll see here 46% of those in our pipeline right now are in advanced manufacturing, 13% automotive, you see food and beverage, back office, and again, that 29% unknown. So it's exciting to see the level of activity that we're facing here in Chattanooga and in our region. In general terms, we also wanted to share with you some information on how we're doing within the competitive landscape of cities and counties throughout the country. And so we like to track, obviously, employment growth as well as GDP. And we've chosen intentionally several peer communities because of the elements of their economies relative to our economies. But in some cases, these are aspirational cities, the best of the best. And we think it's important in Chattanooga and Hamilton County. As you all know, we have a very resilient residency here. We have a resilient community. And so we thought, it's time that we start looking at some of these aspirational communities. And this chart shows us a few cities in the South, several in the West and Midwest, and how we compare as well in Tennessee and in the U.S. You'll see here our employment growth from 2012 to 2017 comes in a bit over 8%. Cities we aspire to be like, again, in some elements of their economy, Provo, Utah, Charleston, and I'll tell you Provo, by the way, is number one on the Milken data, which is in the economic development space, kind of the guidepost, if you will, for economic development prowess. And again, look at how they did, right? Charleston, you see Charleston, South Carolina as well. So again, 14% Charleston, 30% Provo. And other comparable communities like Birmingham, Macon, Georgia, or Mobile are at 3% job growth. So again, we're outperforming. There are hundreds of communities that we're outperforming, but there are a few who are a little ahead of us. So it's our challenge to move our numbers even higher in terms of job growth and wage growth. But again, we are one of the top performers in the country. In terms of GDP, Provo's at 43%, as you see here. We're at 17%, and Tennessee and the U.S. are at 20%. So again, we are ahead of communities like Birmingham, Macon, and Mobile. But looking at this recent historical data, we all see we really have some opportunities as well. And as a collective, we should continue to be very proud of the progress we've made. We've made amazing progress here in Chattanooga and Hamilton County and in our region. And I think these rankings that I mentioned earlier, and there are a whole host of rankings, hopefully our mayors might touch on a few of those, that really solidify that we're doing what's right for our community. But the comparable cities also indicate there are a few who are also doing really well that we can learn from. So a critical element in blazing ahead and improving our community, in our opinion, is the Velocity 2040 community visioning process. And we're deeply grateful. We've had over 3,000 volunteer hours involved in this process, hundreds of organizations and volunteers who have been a part of this process that really launched back in the summer. We've had 2 work sessions with Rebecca Ryan, soon to be 3. And we've had over 100 organizations involved in the process along the way. Many organizations in this room sent out our community survey to their employees. We had other partners like United Way, Community Foundation, others who also helped us with going door to door and canvassing. And so we were thrilled as we looked at the composition of the response rate, which was nearly 5,000 in our community. It really did touch on all pockets of Hamilton County. And those voices, your voices, really are critical to our future and will inform our planning effort. So this vision will inform our planning effort around really focused, bold economic development and talent development strategy, as well as talent recruitment strategy moving forward. So hopefully I'll talk a little bit more at the end about our upcoming news conference, detailing the survey results and also talking about what our community vision will look like. And while the Chamber will play a role in that partnership of advancing the community vision with our numerous partners in this room, we will become very laser focused, as I mentioned, on developing a 5-year focused and bold economic development, talent development, and recruitment strategic plan. And again, we want to thank everyone in this room and throughout the community who's been involved in that process with Avalanche Consulting, because your voices really are critical as we help shape that plan as well as execute that plan over the next 5 years. And while we're looking ahead in 2019, brace yourself. We think it's going to be an exciting year in terms of economic development for Chattanooga and Hamilton County, as well as our region. And speaking of the region, we want to congratulate Nokian Tires. Nokian Tires, as you all know, will open in Ray County, their Ray County operation this year. Some 400 jobs as part of the largest investment ever in Ray County. So that's extremely exciting. And we want to thank our mayors. You know, without Mayor Coppinger and Mayor Burke, they sit side by side with us in our economic development strategies. Without their support, we would not see the success that we have today. It is truly a partnership. We also want to thank the County Commission, the City Council, for their partnership with us as well as our state delegation. We'll be visiting with them today as we take a bus load up for our day on the Hill. Very grateful as well this year for our amazing board of directors. We could not do what we do as a team without our board, and our board chair, Tom Glenn, is here in the audience. So thank you, Tom, for your countless hours working with us and guiding us. And of course, we want to thank all of you, our 2,000 members. From micro businesses to small businesses to publicly traded companies, for your involvement in the community. You lean in, you sit around the table, you help us to strengthen our efforts. You come to us with partnership opportunities, and most importantly, you employ thousands of families here in this community and in our region. So thank you. So I can promise that 2019 will be another exciting year as we work together to attract new business, expand our existing businesses, provide connections for our members, and really work to attract new talent and develop the talent that's already here through Chattanooga 2.0 and a variety of partnerships in this room. And we believe that together we can literally make Chattanooga perfect for everyone. So now, please join me in welcoming Mayor Jim Coppinger and Mayor Andy Burke for their remarks today. Thank you, gentlemen, for your partnership, and welcome.
Well, good morning, everybody. It is a pleasure to be with you for another great chamber breakfast. I want to thank Christy and the entire team at the chamber. It is a pleasure to work alongside them, and I know what you heard earlier and what you see every day is that the chamber has big plans about how Chattanooga can move forward, and we appreciate them. I'm also joined here this morning by a number of city council people. If they'll stand, we have our city council chair, Ken Smith, our vice chair, Erskine Oglesby, and Councilman Darren Ledford. Please give them a round of applause and thank them for their service. I also am up here with Mayor Coppinger. I don't know how many times we're going to see each other today, but most days we interact several times. We have a standing meeting every 2 weeks. The city and the county try really hard to stay as one. That doesn't mean we always agree, just like nobody agrees, but we tend to find our way through it to the other side, and it is a pleasure to have someone who's trying to problem solve alongside us, so thank you, Mayor Coppinger. We live in a city of creators. It's a city that is constantly trying to figure out its way forward, and if you think about the history of who we are, this act of creation is something that I've seen over the course of my lifetime here. And that's definitely been powerful over these last several years because our creation is happening at a rate that's higher than our peer cities. So in 2017, the last year that we have data for, Chattanooga had the 6th highest wage growth in the country. Not for a mid-sized city, for any city. Over those last several years, we've had the 3rd highest wage growth in the country for any mid-sized city. And these wage issues are really powerful because they add so much to what's going on in our city. We are the fastest growing city of the Big 4 in Tennessee. That's right, by percentage, even faster than Nashville. And then again, in 2017 and 2016, we created jobs at twice the national average. And this city of creators has a diverse economy because over the last few years, that's been something we've tried really hard to do. We have major employers like Volkswagen and the automobile sector, financial services, ones that we've seen, many of whom are represented here, and we are thankful that they continue to grow. And as Christy pointed out, we also have this next level that honestly you really can't call startups anymore. They are growing companies, they're fast-growing companies, but like Bellhops and Freightways and others, that Steve Case, when he came here, highlighted Chattanooga as the rise of the rest. And importantly, the AOL founder didn't just come here and do that. If you've seen his public appearances, he's out across the country talking about what's happening in Chattanooga, Tennessee. And then you even have that smaller group, like we have GMST Transportation, which got one of our Kiva loans. That's city and chamber and other organizations that are supporting these small new startups run by a person of color who are finding out ways to do medical transportation in our city. At every level, we're seeking a diverse type of economy. But I also, and I don't know what Dr. Bostic's going to talk about later today, but we see headwinds ahead of us. There is a national economic expansion that's been record long, but seems like it's waning. We have a federal government that is broken and dysfunctional at every level. And we have lots of state and other entities that don't embrace local solutions that spark innovative policies. All those are problem signs ahead. But together we can forge that creative future together. So a couple of things. Number one, we have to continue to focus on wages. Wages are what bring development to our city. That's why we have thousands of new apartments in our downtown. That's why record permits are at record highs, because people have more money and they don't just need a job in today's economy. They need a job that can pay the bills. That's why wages are so important. The second thing is we have to support families in our city. And I'll tell you that it's the right thing to do morally, but it's also the right thing to do economically. When we support kids like we're doing through our Office of Early Learning, that doesn't just help the kids, it helps the families and the parents. They come to work more often, they're happier when they're there. Supporting families is critical. That's why I made the pledge last year to open 1,000 new high-quality early learning seats, and we will see that happen. And then finally, we have to be focused on the future. The amazing thing about our city is that we're always thinking ahead. We know the pain of living in the past. I saw it when I grew up here. But we, over the last few decades, have been known as a city that's looking to the future. Each of us is imperfect, just like our city. But God gave us the power to create, to find that new future. I believe that's what we have always done, and that's what 2019 will bring for us. Thank you for letting me be part of this journey.
Well, good morning. It's good to be here with you and beginning of kicking off 2019. I want to begin by saying that a special thank you to Christy Gillenwater for her leadership at the Chamber and the fact that I have the opportunity to work with Charles Wood and Steve Hyde on economic development issues. It's an honor to work with them. Appreciate their commitment and look forward to continued success. There's not members of the County Commission here because it's a commission meeting morning, and I'm sure they're dealing with issues that will be before them today. But all of the county government officials that are not represented here today because of that, I want to be sure to say on the front end how grateful I am for their participation. I'm going to talk about a number of successes. Christy mentioned in the region. I'm going to be more specific about Hamilton County. And I want to say to each and every one of you in this room, the reason that we've been so successful as we go through these numbers is because of your participation, the participation of the city, the state, our federal government, our philanthropic community, our public-private partnerships, and a lot of our foundations. So again, congratulations to each and every one in this room and to the governments for the success. I too would like to add that the relationship that Mayor Burke and I have as we continue to try to move Hamilton County and this city forward. I only wish that we could share that throughout this country. I think it's people working together that makes things truly work and brings about success for everyone. So I'm glad to be a part of that. I will say that Hamilton County's economic outlook for the future remains extremely bright. Last year, we created 759 new jobs. And again, I'm talking about just Hamilton County. And in the last 8 years, just in Hamilton County alone, over 15,000 new jobs. We have new companies that are coming to Hamilton County, and we have expanding businesses. Both of them are extremely important to us. 52 new businesses have come to Hamilton County, and 107 have expanded, and 12 of those just this year. We remain excited about expansions as well as new businesses. In 2018, we saw an economic investment of over $400 million just here in Hamilton County. That is added to the $2.6 billion that we've enjoyed over the last 8 years. We're continuing to invest in our workforce development. We get a lot of help from a collaborative effort that we have with Chattanooga State, UTC, the Chamber, and certainly with what Dr. Brian Johnson has implemented with our Futures Ready Institutes in our high schools. We're excited about the future of our public high schools, and we're excited about our workforce readiness in the future. Our county is growing, which is great news for our taxpayers, our home builders, our realtors, and many others. Growth helps us to minimize the amount of taxes on our property owners, and it also helps to attract businesses. And the more growth that we have, the more homes that have to be built and the more that are being sold. So again, we're excited about our growth. Our construction value for 2018 was over $200 million. It was an increase of $54 million from the previous year. New housing for 2018 is valued at around $150 million. That's just new housing. And the construction of over 900 new units. That's an increase of just 3 years ago when there was 597 units that were built. We're also growing in population. The U.S. Census says that we've grown by over 25,000 people since 2010. And as of July of 2017, there was 361,125 people now living in our county. What does this mean? It means new homes, it means new businesses, and it means new schools, but it also means additional demands on our infrastructure, something that you may be hearing about recently. We have to meet those demands. We will continue because of the growth and the expectations of the national organization that just recently predicted that over 10,000 new homes will be built in Hamilton County by 2022. This means there's going to be additional subdivisions, again, additional stress and strain put on our infrastructure that we must address and we will address. So in closing, I want to once again reinforce the way that we've gotten here with this success. And again, the numbers that I read off to you are just Hamilton County specific. But the way we got here was working together. And it's an honor and a privilege to get up every day and to be able to serve and work with all the people in this community. And with the continued success will depend a lot on the people in this room and the people out there that have continued to help us over and over again. Thank you.
Thank you. Okay. Thank you. Well, as you all know so well, we have two extraordinary mayors who are very committed to economic growth. They're very proud of our economic growth, as you see, as they shared specific numbers. And obviously, you hear from their comments what they are passionate about, what they're driven by. And that's why their partnership really is so critical. And they really are lead partners. And what you see in terms of everything going on in this community, and exactly as they stated, why we should all be collectively proud of what Chattanoogans and Hamilton County residents have been accomplishing over the past decade. All right, so now we'll get into introducing Dr. Raphael Bostic, our keynote speaker today. So Dr. Bostic serves as the president and CEO of the Federal Reserve Bank of Atlanta. He is responsible for all of the bank's activities, including monetary policy, bank supervision and regulation, along with payment services. In addition, he serves as the Federal Reserve's chief monetary policy body, serves on there, the Federal Open Market Committee. Dr. Bostic's experience spans academia, government, and research. He's passionate about understanding the housing sector and how credit markets, financing, and public policy work together to help people achieve the American dream. Since joining the Atlanta Fed as the 15th president and CEO, Dr. Bostic has spent much of his time on public outreach, sharing his deep knowledge of business and financial conditions. Dr. Bostic has been published extensively in academic journals. He earned his PhD in economics from Stanford University and his undergraduate degree from Harvard. Please join me in welcoming Dr. Bostic with a warm Chattanooga and Hamilton County welcome. Thank you for being with us today. Thank you so much.
Good morning, everyone. I want to thank you, Christy, for the generous introduction. I have to say I'm really pleased to be here in Chattanooga. As Christy noted, I'm not from, well, she didn't say this, but I'm not from here. I'm actually not from the Southeast at all. And one of the great parts of my job has been to really go around and get a sense of the district and try to understand what's happening on the ground so I can represent you and your experiences in the Federal Open Market Committee. I'd like to recognize a few people. First, Ben Brock, who is one of our bank's directors in the Nashville branch. I also want to highlight or call out Craig Hawley, who's a former Nashville branch director. And I also want to thank Chattanooga Mayor Burke and Hamilton County Mayor Coppinger and all the other elected leaders here for your leadership and your guidance in helping Chattanooga move forward. We at the Federal Reserve Bank of Atlanta see Chattanooga as an important city in the 6th District. 3 years ago, the Atlanta Fed's Community and Economic Development staff highlighted your city's well-documented resurgence as part of its Small Cities Study Tour. They went so far as to describe Chattanooga as the poster child for the modern American small city renaissance. And what made the difference? A unique network of committed funders, leaders, and volunteers that drove development and innovation. And this network has been complemented by an engaged and active local government that sustained these efforts. Over time, progress has become an expectation here. You are driven by moving toward the next great thing for your city, and then by telling your story well. And many of you here are responsible for this inspiring story. I applaud your vision and your energy. At the national level, we begin the new year with some of the same hopefulness for the economy. Yet there seems to be a dichotomy between the strength of the economic data that we have in hand and the many expressions of uncertainty that we have been hearing about the path of the economy moving forward. Today, I'd like to explain how I am analyzing these crosscurrents as I form my views on monetary policy. I'll begin with current conditions and talk about some of the tools we have and outreach we conduct at the Atlanta Fed that go well beyond the official statistics to help inform us of emerging trends. I'll explain how the Fed's connection with Main Street is a key element of what I mean by data dependence. Then I'll offer my economic outlook and some of the risks that I am seeing around that outlook. And at the end, there will be some time for questions. And when that time comes, please come up to the mic that we have in front, and I'll be happy to take as many as we have time for. Now, as always, the views I will express are my personal views. My colleagues on the Federal Open Market Committee, or FOMC, and in the Federal Reserve System in general, they may not think that I know what I'm talking about at all, and they may not agree with what I'm going to say today. Now, looking back, it is clear that 2018 was a stellar year. Real gross domestic product, or GDP, likely expanded by more than 3% on a year-over-year basis in 2018, making it the strongest full year for growth during the current expansion, which is now more than 9 years long. Perhaps equally as impressive, the unemployment rate was at or below 4% for much of 2018, and payrolls increased by more than 2.5 million workers. Inflation, as measured by the Personal Consumption Expenditures Price Index, on a year-over-year basis, trended toward the FOMC's 2% inflation objective. In short, the official aggregate statistics for 2018 looked quite good. This is an economy that, by all appearances, ought to be able to stand on its own without much support or accommodation from monetary policy. And it is largely from this standpoint that I supported the 25 basis point increase in the federal funds rate at the December FOMC meeting. With this move, I think the committee has likely come close to achieving a neutral policy stance, one that is neither providing accommodation nor is being restrictive and attempting to actively slow the economy. Now, I say likely because the neutral interest rate is not something that we directly observe, but rather it is something that we infer from mounds of data, economic and statistical models, and a healthy dose of judgment. There's a fair amount of uncertainty regarding these estimates of the neutral rate, so we need a data-dependent approach to monetary policy moving forward. Now, any avid Fed watcher has without a doubt heard the phrase data dependence myriad times. But if you'll indulge me for a moment, I'd like to explain what that phrase data dependence means to me. Yes, data dependence means paying close attention to official data releases that help inform us about the aggregate economy from three-lettered organizations headquartered in Washington, D.C., places like the BEA, which is the Bureau of Economic Analysis, and the BLS, or the Bureau of Labor Statistics, for example. But it also includes monitoring data regarding financial market conditions, data that inform me about global economic conditions, and data from a variety of surveys to keep me abreast of changes in sentiment that may affect business and consumer decision-making. I look to these other sources because more often than not, available data aren't sufficient to get a full view of developing economic conditions. This is the reason that my execution of data dependence employs multiple efforts at the Atlanta Fed that go well beyond just tracking the official statistics. In some cases, we have taken publicly available data and created new tools that are more closely tailored to the needs of a central banker. One of these tools is the Wage Growth Tracker, which gives us a read on wage growth that's less likely to be influenced by changes in the flow of people into and out of employment. Another tool is GDP Now, which is a tracking estimate of current quarter real GDP growth that's designed to mimic the BEA's procedures and give us an early heads up on the next official GDP estimate. Now, both of these tools are available on our website, and I encourage you to sign up and follow them. You guys should be doing this all anyway, right? So, GDP Now, Wage Tracker. All right. Well, in addition, my views are substantially informed by several efforts at the Atlanta Fed that leverage the knowledge of people like you here in this room. Two important initiatives are a business inflation expectation survey and the Survey of Business Uncertainty, which we developed with partners at the Chicago Booth School and Stanford University. These surveys fill gaps in the data regarding the inflation expectations of firms and how today's environment is affecting their decision-making and uncertainty about hiring and capital investment plans. But I also lean heavily on an extensive network of business contacts, community groups, and nonprofit organizations. Some of you are familiar with the Atlanta Fed's Regional Economic Information Network, which we call RAIN. Many of you, I hope many of you, know Laurel Grafey and her colleagues at our Nashville branch, who are with us here this morning. So Laurel, would you please stand up and wave for the crowd? She's important, so you should know her, everybody. And when she calls you, you should please take the call. But Laurel's full-time job is to keep me plugged in to the economic conditions on the ground. And she's not alone. RAIN executives and their staffs in our 4 other branches and the Atlanta office help me glean a broader, more in-depth picture of the health of the economy than I could capture with my own outreach efforts or from economic models and official data alone. RAIN is my critical connection to Main Street. And this Main Street connection is a key element of what I mean by data dependence. Now, ultimately, I have to turn all of these various data collection efforts into an outlook for the overall economy. By its very nature, monetary policy has to be forward-looking, and the various sources of hard and soft data are useful in guiding my assessment of what the future is likely to bring and what important risks there are to that outlook. My current baseline outlook for the U.S. economy in 2019 is for another year of solid growth, although I do expect growth to be a bit slower than in 2018, as the temporary effects from fiscal stimulus and tax reform begin to fade. From there, my projection is that growth will ease further to a bit below 2% by the end of 2020. It's important to stress, though, that this lower pace of growth does not reflect fundamental pessimism about the economy. Rather, it mostly reflects the reality that the size of the working age population, which is the key input into producing goods and services, is expected to grow much more slowly over the next decade or so than it has in the past. And inflation, in my baseline projection, remains relatively close to the FOMC's 2% target, reflecting my confidence that monetary policy will be able to foster price stability amid robust labor markets and alongside the solid trajectory for growth that I just mentioned. Now, could the economy grow faster than I expect without causing a breakout of much higher inflation? Yes. It is possible that labor productivity, the ability to produce extra value for every hour worked, will grow more rapidly than it has over the last decade. Over the past 10 years, productivity growth has averaged 1.3% a year. And this is a stark contrast to the nearly 3% pace experienced during the early 2000s. So why don't I have a significant pickup in productivity growth baked into my outlook? And it's primarily because a key driver of productivity growth is capital spending. And readings on capital spending since mid-2018 have been relatively subdued. They are not consistent with the business sector ramping up for significantly expanding capacity. For example, overall investment in equipment and software appears to have slowed, while investment in non-residential structures has declined. And moreover, recent business survey readings on the outlook for capital expenditures in 2019 have softened considerably. Now, I'll admit that changes in productivity are difficult to anticipate, and perhaps we are on the cusp of a new era of higher productivity growth, but the data and my contacts are not telling me that today. So absent a sustained uptick in productivity growth, better than expected GDP growth will require a continued strong pace of hiring. But the prospect of continuing to add roughly 200,000 jobs newly to the economy each month will be increasingly doubtful without risking a significant rise in labor costs and potentially higher inflation. By most measures, labor markets are already tight. The national unemployment rate is at a roughly 50-year low, and here in the Chattanooga area, it is as low as it was during the late 1990s. Business leaders I speak with have been increasingly frustrated by the difficulty in filling vacancies and retaining staff. Workers are leaving their current jobs for new ones at a very high rate, and yet firms are reporting that it is taking longer and longer to fill vacancies. That said, we haven't yet seen any evidence that growth in labor costs has become significantly disentangled from average productivity growth and stable inflation. But it's definitely something I will be watching as 2019 unfolds. Now, as you might expect, given the recent upheaval in financial markets, there are many additional risks to my baseline outlook. I view the recent market turmoil not as the cause, but rather a symptom of the various concerns and uncertainties surrounding the outlook. These include slowing global growth, uncertain trade policy, worries over the trajectory of growth domestically, and a concern regarding the expected stance of monetary policy. In face-to-face interviews with contacts and through the efforts of RAIN, businesses in the 6th Federal Reserve District appear to be growing more concerned about future business conditions, creating a risk-off environment with regard to business plans. To this end, I heard a few reports that companies are starting to examine their own business strategies and initiatives in anticipation of slowing economic conditions, either through deleveraging or holding off on expansionary projects. Worries over tariffs and trade have dominated the conversations about the outlook and are present in the survey evidence that we collect. Every December, for the past few years, we have asked 6 district firms in our Business Inflation Expectation Survey to provide their biggest concerns for the year ahead. We then categorize their responses into a broad set of topics. Over the past 3 years, costs, perhaps not surprisingly, has topped the list. But the interesting part is that inside this broad category, the main driver of cost concerns has changed each year. This year, tariffs emerged as the dominant source of concern regarding business costs in the year ahead, even outstripping concerns over labor costs. While these businesses appear to have absorbed the initial round of tariffs, should tariff rates increase from here or encompass a broader set of goods, my contacts have said this would likely create significant challenges. Many appear to have reached their limit on cost-absorbing measures, making a possible next round of tariffs a more direct hit to the consumer. Concerns over what that would do to sales growth are top of mind among these business contacts at the moment. So grassroots intelligence from Main Street and messages from Wall Street indicate heightened uncertainty and concern about the economy. But the aggregate economic data continue to paint a robust picture. So what is a policymaker to conclude from these mixed messages? To me, the appropriate response is to be patient in adjusting the stance of policy and to wait for greater clarity about the direction of the economy and the risks to the outlook. Should conditions play out along my baseline outlook, I see little need to engage in restrictive monetary policy and push the federal funds rate above a neutral stance. All the available evidence at the moment points to caution regarding firms' approach to expansion, and as long as that caution exists, I suspect it will act as a natural governor, limiting inflationary forces without the need for muscular monetary policy. But I'm not taking this outcome for granted. My staff and I will continue to closely monitor the path of our progress in meeting the Federal Reserve's objectives for both maximum employment and price stability. To sum up, my view is that a patient approach to monetary policy adjustments in the coming year is fully warranted in light of the uncertainties about the state of the economy and about what level of policy rates is consistent with a neutral rate. And this is what I mean by data dependence. So thank you for listening, and I'm happy to take some questions.
Questions right here, please. Those of you who have questions, if you would approach the mic. We have quite a few moments for questions, which is perfect.
Everyone has been stunned into silence.
Here they come.
Good morning. So both job reports and the GDP were up for 2018, but now we're in the midst of a federal shutdown. So what effect will that have, and when will we see it reflected in the economic reports?
So that's a good question. Here's what I would say on this. With the shutdown, part of the issue is how long it lasts. All right, what we've seen so far is a relatively short period of time. I think the first paycheck that would be material is the end of this week. And so for most families and for most businesses, the impacts have not been direct. There are some examples and exceptions. So there, for example, in the housing assistance space, there are some contracts that needed to be renewed that were not able to be renewed. So some landlords are not getting payments that they might have expected. That's created uncertainty for the families that are living in those units, and so there's real effect there. For us, one of the biggest effects of the shutdown has been around data. So I talked about the BLS and the BEA. Well, they're not doing the things that they might do to give us the inputs that give us some sight lines into the economy. So we're worrying about that as well, because that will make our data dependence and our outreach efforts all the more important. But as this moves forward, if the shutdown continues for quite some time, I think we will start to see some effects. Households will have to make decisions to the extent that they can about which goods they will purchase, or whether they purchase any goods at all. And that will then flow through to sales and your outlook from a business perspective. And really, it will push back the types of growth that we have projected in our outlook. So in this instance, we're just going to watch and see and hope that there's a quick resolution to this, so that the ripple effect is as minimal as possible.
You mentioned that we talked a lot about wage growth being a pressure on employers. Wanted to, kind of get your thoughts. Is that across the board, or is that middle class? Is that upper class wage growth? And are you seeing it in rural America, or is it concentrated mainly in larger cities?
So there are a couple of questions there. Let me speak to the second one first. So one of the things that I've done as I've gone across the 6th district is really try to make sure that I go to places that represent a diversity of economic realities. I've been to some rural places, some mid-sized cities, and some large ones. And what I've seen is that there's not just one U.S. economy, but rather there are multiple economies that people are experiencing. We have really successful cities that are growing. There's a lot of innovation. This would qualify as one of them. Atlanta, if you ever come to where my bank is, you see cranes all over the place. It's very exciting, and there's a lot of innovation going on. But then you can go to many smaller places, and places that are far from the big cities, and there's a different reality. And in those places, there are concerns that the economy is leaving them behind, and that opportunities are not as robust as they might be otherwise. Much of the wage growth that we're seeing is happening in sort of the more urban places where there is success. There are stresses that are starting to emerge in some rural economies and rural markets, because population is leaving, right? And so the availability of labor in those places has started to recede a bit. In terms of, is it broad-based and in what parts of the employment structure it's happening, the reports that I've heard suggest that much of the stress is happening at the entry level. If you talk to restaurateurs and others, they are starting to really struggle to retain their entry-level workers because there are other alternatives that are around. And so I mentioned that workers are leaving at high rates. Many of them are at the low end of the wage scale. So that's been a pressure. We've always had pressure in a number of those hot job categories. So you think about the engineers and the tech folks. Nursing is an area where we've had shortages. And trucking has been one as well. People don't often think of trucking as the sexy, hot thing. But there are opportunities. There's a tremendous shortage of them. And so we're starting to see significant wage pressure in that space as well.
Labor productivity growth is one of the key drivers of overall economic growth. I've asked some of your colleagues at the Fed why it is that until very, very recently, labor productivity was rising very, very slowly. I was fascinated to hear that you think it is picking up. I wonder if you could explain this conundrum.
I don't think I said it was picking up. So the statistics I quoted, in the early 2000s, productivity growth was around 3%. For the last 10 years or so, it's been at 1.3%.
Yes. Oh,
right. So it is much slower than.
It is still low.
It is low by historic standards, and it is putting a ceiling on how fast the economy can grow and what our GDP growth can look like. Part of what we're looking at, and my team, is whether businesses are making investments that allow workers to be more productive. Right. Are they making those capital investments to change their processes and find innovative ways to produce goods so that we get more productivity from workers for every hour that they work? And as we move forward, I think we will really try to understand, for example, what businesses are doing with the proceeds from that have accrued because of the lower corporate tax rate. That could be an opportunity for a robust increase in the amount of investment that we see that is productivity enhancing. What we've seen the first year is that does not seem to be what has happened. We've done a number of surveys where we've asked businesses, what's happened to your capital investment plans for 2018, for 2019. Almost 3/4 of respondents say we haven't changed them at all. All right, so we haven't seen that. But we will continue to monitor that moving forward because that will be an important component of seeing elevated levels of GDP growth.
Thank you, sir.
Hi, thank you for taking questions. My name is Elizabeth Rowland with Tennessee China Network. We're a nonprofit to promote trade and investment between Tennessee and China. You'd mentioned the trade tensions and the tariffs causing business uncertainty. And I was wondering if you could talk a little bit about the investment side. I've heard that last year Chinese investment into the U.S. slowed a lot because of a lot of the uncertainty among other issues. But that recently it started picking up again, perhaps because they see this uncertainty on the trade front continuing for a while, and so they're starting to want to jump the tariff wall. Do you see that happening, and how do you see that affecting the economy going forward on the foreign investment side?
One of the most significant responses to the uncertainty that we've seen, and when I've talked to business leaders, and we see it in our surveys as well, is to pause. To not start new things, but rather just continue with the things that they've been doing, and then wait and see how things play out. Because all of the uncertainty in policy means that there's uncertainty in the rules of the game. And if you don't know what the rules of the game are, it's hard to know whether a particular investment opportunity is going to be profitable or whether it's not. And so what we've seen and what we've heard is that if they have things in the pipeline, they're going to work through the pipeline because stopping those comes with its own set of costs. But big new investments, there's been a big pause on that. I haven't heard reports of capital from China flowing into the United States at higher levels than perhaps a year and a half ago. But that's interesting. That's something that I will start asking people about as we move forward.
Thank you.
Good morning. A renewed interest in a gold standard has been the subject of a recent PBS documentary called In Money We Trust. And I wondered if you could talk briefly about what the implications might be in reintroducing gold as a monetary standard.
Well, it's not something that I'm really entertaining right now. It would be a significant change in how we move forward and in how value operates. You know, when I think about the gold standard and some asset-based sources of exchange, I get drawn to things like cryptocurrency, which is another space where we hear a lot of advocacy to say this should replace the way that we do payments in the past. For me, if you look at the cryptocurrency markets, they don't operate the way I would like a currency market to, if I wanted to ensure that the value of the assets that I had was going to be the same tomorrow as it is today. So if you take Bitcoin, for example, it's probably the one that you're most familiar with. The value there has decreased by 80% over a relatively short amount of time. If you are someone who doesn't have a lot of disposable income or extra buffer, that kind of fluctuation in value is going to be material. And it will be harder for people to operate in that context. Now, we did a survey at the Federal Reserve. The board in Washington ran the survey. And they ask, and they do this every 2 years now, and they ask, if you had a $400 shock to an unexpected cost hit, could you weather that? And what we've gotten as responses is that more than 40% of American families could not do that. All right, so that's a large number of people who are really living on the edge. And in that context, having volatility in terms of the value of the assets that they do have, I think that puts even more strain on them. And so I'd be very reluctant to move to vehicles where there's some degree of volatility that will come into play.
Good morning.
Good morning.
Question for you on artificial intelligence. How do you think artificial intelligence will impact GDP and employment as we move into the future?
So that's a big question. So I guess in thinking about this, we have to first talk a bit about what is meant by artificial intelligence. There are lots of different ways that technology gets introduced into the production process. So one is automation, right? And if you think about automation, what that can do is actually many different things. So in some instances, you're going to see automation reduce the need for workers. There are going to be some fairly straightforward processes that a machine can do just as easily as a person, and the machines will eventually take more and more of that space. But there are other sorts of automation that require new types of skills. And so I've talked to a number of employers who have said, when we introduce our new technology, that will come with it a number of new jobs that we need to fill. And so the automation will create new opportunities for work. And in some instances, what employers have told me is that the net is basically zero. Now, the challenge is that the skills for the new jobs are not the same as the skills for the old job. And so there actually is a loss. And the people that were there before, if they do not get retrained, could be in a much worse place. And I'm happy to hear, Christy, you were talking about the workforce development efforts that are going on here. We in the 6th District of the Atlanta Fed really believe that workforce development is one of the most important things that our economy has got to grapple with, our society has got to grapple with. Because as the economy evolves, there will be a number of stresses, and we're going to have to reposition a lot of workers so they are employable in the industries that we have moving forward. So that's one set of artificial intelligence. There's another set of artificial intelligence or area where you might develop algorithms that evolve. Right, so it's actually, you've heard people talk about machine learning. There actually is real learning that happens. And that's a whole another very complicated area because in one instance, you might see that learning increase efficiencies so that production happens at a much more efficient level. We see that increased productivity that I was talking about earlier. But in other instances, that learning can occur in ways that might run afoul of guardrails that we've put into our economy. So for example, it may be that these programs learn that the name Hernandez is correlated with certain sorts of outcomes and starts to make decisions based on names or genders or ethnicities which are not legal in our system. So as we go down this path, it will be important for us to make sure that we have ways to monitor how these systems evolve, to make sure that they operate in ways that are consistent with the values that we've established in this country for how business should be done.
I think we can take one more.
Dr. Bostic, thanks for your remarks. In discussing data sources, you talk about hard and soft data, and you did make reference to financial data and asset market information. Two questions, if you will, to side. What is the information you're getting from the yield curve right now? And how do you factor stock market type activities into your forecasts?
So let me speak to the second first. So when I think about the stock market, it gives us a signal of where financial investors think there are opportunities and risks and how that's changing over time. So when I see changes, I try to say, well, there's a signal that there are more opportunities or more risks, and then try to reach to my contacts to see whether they're seeing the same thing, and also to understand whether they're changing their behavior because of the sense of those elevated or reduced risks. If they're not changing their behavior, then for me it's really on a watch list, so that I don't necessarily need to change my outlook, but I just need to be more diligent in making sure that I'm aware of how these changes are flowing through the economy. And so in the financial space, for me, these are triggers that I need to ask more questions so that I can get a real sense of what's happening on the ground for Main Street businesses across the district. Your first question was on the yield curve. So does everyone know what the yield curve is? That wasn't every hand. All right, so when we think about the yield curve, there are bonds that occur at different maturities. Right, so you have the 3-month, the 6-month, the 2-year, the 5-year, the 10-year, the 30-year. And there's a yield or an interest rate that's associated with each of them. And so the interest rate under ordinary circumstances should be lowest for the shortest bond and highest for the longest one, because if you're going to allow someone to have your money for a long period of time, you want to be paid for that because there's more risk that's associated with that exposure. So if you wanted to plot those, that plot is called the yield curve. And in this space, the yield curve should be upward sloping. If you do the shortest one on the left and the longest one on the right, it should progress up. And what the yield curve tells us is how much risk the financial markets see over a time period. And so there's an industry basically that monitors the shape of this yield curve. And if the low rates are elevated relative to the high rates, the curve actually starts to get flatter. And we call that the flattening of the yield curve. So when the yield curve gets flatter, that's a signal that the markets believe that there's a convergence of risk in a temporal space, in that the risks over the long run are looking comparable to the risks in the short run. And some would say, and the data is fairly clear on this, that if the risks in the short run get sufficiently high, that will get us to a recessionary position. And so as the yield curve flattens, we need to be mindful of the changes in the short run risks to make sure that, the economy is going to continue to grow and not shrink. So the yield curve is pretty flat right now. And in part, some would say that the Fed has contributed to that in the sense that in our balance sheet space, because we own a lot, we control a lot of long-run mortgages and bonds, that's pushed down the long end of the curve. We know also that the U.S. is a place where in a world of uncertainty, there's going to be a heightened flight to safety. And so that will also put downward pressure on some of the longer bonds. And so there are signals. I talked in my remarks today about uncertainty in the economy. Those are short-run risks for sure. But there are other things that are going on in the economy as well, which mean that we have to step back and not take the shape of the yield curve by itself as the sole indicator of whether we're on the cusp of a recession or not. And I said this on Monday. It's my goal that we have no recessions while I'm in this chair. And so I'm going to do all that I can to make sure that that yield curve, that whatever shape it has, is not perceived as a signal that we have an oncoming recession.
All right. Dr. Bostic.
Thank you.
Thank you so much.
Thank you. Really enjoyed it.
Well, I hope I speak for all of you when I feel a bit more confident about our economy, hearing from, knowing that we're in such good hands with you at the Fed in Atlanta. So thank you so much, Dr. Bostic, for your thoughtful projections on our economy this year. We really appreciate your time and the attentiveness of you putting that together. In closing, a few thank yous, and then I want to leave you with some thoughts. Thank you so much, again, Dr. Bostic, for being with us. Thank you again to our two mayors for their partnership. Thank you to all of you who partner on a daily basis. I want to thank our board, again, Tom Glenn, and our chamber team. If our team, colleagues on the staff could raise their hands. We have an amazing team, produce outstanding events like this one every day. They work tirelessly to meet member needs, to make sure that our economy continues to grow and expand, so thank you all. As Dr. Bostic referenced to me, when we think about workforce development, to me, a lot of it really comes back to how do we increase our labor participation rate, not only here in Chattanooga and Hamilton County, but throughout the country. And I think we are a model community when it comes to true collaborations. We have a history of that when we think about the history of visioning here in Chattanooga and Hamilton County, and how leaders for decades have come together to think about a better future than what we've had in the past. And I think I see that resiliency as well in our businesses. And that's what we're so excited about right now through Velocity 2040, through Chattanooga 2.0, which, by the way, is a cradle-through career model that no one else in the community, I should say in the country, no one else in the country is doing to the level that we're doing. There has been so much thought and passion around the table around how can we work as a collective to not only change the path of those yet born and those who are being born today, but also for those who are sitting out there who are not participating in the labor market right now. So really amazing work going on in that space, and we appreciate all of our partners who are at the table. In closing, on the Velocity 2040 front, again, a collective vision that we can all work on here in the future, right? How do we help our neighbors find more gainful employment? How do we help our future children have better access to education, right? How do we help our businesses continue to thrive? And by the way, thank you so much for thriving and for all the jobs that you provide and all the families you provide food and income for. So Velocity 2040, we hope you can join us on February 7th, 10 a.m., where we will talk about not only, again, our vision for the future, but also the data that we collected from those 5,000 voices, your voices. That'll be really important. And again, we'll create the clarity that we need for a dynamic economic development, structured approach moving forward. In closing, I want to tell you, one of the words that I always come back to when I think about Chattanooga and Hamilton County is resilience. And I am so blessed, and we as an organization are so blessed to be part and partners in this community of building a resilient economy. I think of resilient people here. I think of resilient companies. I think of a resilient community. And as Glenn Morris with M&M Industries, many of you know Glenn. I was out visiting with him yesterday. And I want to leave you with this thought that I thought, that's the way I want to end my comments tomorrow. Before I say thank you to all of you for being here first, thank you for being here. But the world needs a few more Chattanoogans. We'd have a much better world if we had more Chattanoogans out there. So thank you all for being with us. We wish you have a great day and a great year. Here's to 2019. Thank you.